Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
Yeah, what's the point? What's the point anymore? Why do we do all this? We toil, we slave for what? So that in 2 weeks I get my Medicare card. What are you pointing to?
You're too hot.
I am?
Yeah, you're a little bit hot there.
All right.
I think you're just getting all worked up about getting the Medicare card.
Oh, gosh, yeah. Oh, yeah, you're right. I was.
And it sounds like, by the way, you may need it. You sound a little croaky.
I got a thing. I got a bug.
Yeah, and this is not COVID, right?
I don't know.
Put my mask back on?
I don't know.
Do I need it? Because it travels by air, right?
Yeah, and we're on the air.
I know. I'm just saying.
It's and it's it's the new variant. It's the E-COVID. It goes over. It goes over the air, the electronic thing.
As long as it's not the F-COVID.
No, actually, I'm going to get a COVID test tomorrow because they say that if you've had both shots, sometimes you can get a minor. But listen to my voice; it's like
minor. Until like going through puberty again or something.
Yeah. And there aren't a lot of people going through puberty who are getting their Medicare card in 2 weeks.
That's a slight delay, and I would check with my doctor about that as well. Get the test and ask while you're there.
Golly.
Both.
So please forgive me if I don't sound like me today. At least I have Tom to annoy you. So you won't have John McDonald to kick around.
I'm still getting over the lady with the bad joke thing when she called and she said, I'm glad to interrupt the bad jokes. I said, well, those are Don. She goes, no, he's funny.
It
kind of killed me.
It made me feel
I'm not sure I'm ever going to get over that
I need her to call back today at 855-935-TALK, 855-935-8255. She can bring me a little bit of joy and some virtual chicken soup. That'd be great.
I was going to say tea and honey maybe might sound better in the back of that throat.
And my bourbon, I'm out of bourbon.
Oh, never fails, right? Right at the critical moment.
Maker's Mark has left the building. Darn it.
Can't you order that through Amazon?
I can. I could order it through
have it there by 3:00.
Through Shipt. I'm going to just right during the show order it through Shipt.
There you go.
Hi, everybody. I'm Don McDonald. Such as I am. Over there is Tom Cock, such as he is.
Hello.
And this is a show called Talking Real Money, where guess what we do? Yeah, we talk about money. And today we want to talk about something that has a lot of people concerned. Suddenly, inflation seems to be rearing its ugly inflationary head again, Thomas.
Yeah, and after really being gone for, almost a decade.
Yeah, 40, 50 years,
very
long time. Just
not that decade, not for. I'm old enough to remember the late 70s, early 80s when we had the, interest rates were at 18, 19%, where it was crazy.
And since I'm just a teenager, I can hardly remember that.
Yeah, exactly. So, by the way, this only applies if you have money left over after paying your taxes. So, some of you may not be important.
I got a refund. I don't know about you.
I know. Right now, everybody in the West Wing is having steaks on my return, so they got to like that. Yeah, inflation, depending on which measure you use, has gone from 1.3% annualized to somewhere around 2.5%. That's a pretty big growth in a year's time, right? That's a pretty big increase.
Yeah, it is.
And the indications are, and nobody ever knows this for sure, that's why some people sold a lot of their stocks this week, that the market had a rough week, right? We were down a little bit, especially a couple of days earlier in the week, had a little rebound. But the question is, what do you do from here if inflation is truly upon us? You made a good point today.
Hold on. The most important word in that sentence is the two-letter word, if.
Yeah.
If.
You raised
We don't know this.
It might be very temporary due to certainly all the cash that's out in the sort of the post-COVID, the government throwing all this money and stuff. We don't know if this is really going to be a real long event or what the deal is. But what do you do? And everybody's got advice on this. A client brought this to my attention a couple of nights ago that James McIntosh wrote about the ideas. The first idea that a lot of people have, I know you're going to love this one, Don. It's going to make you feel better all over, and that is put it in gold, because gold is a great inflation hedge,
Let me hit
right?
my cough switch. Oh,
Feeling
really?
better now?
Oh, gold, huh?
Yeah, gold.
It's funny you mentioned that, because I just got a note from somebody, a question for a future show or podcast about just that, and I was doing some gold research because somebody was saying that gold from 2008 to 2009 was such a great investment. And yeah, if you pick that one little narrow period, it wasn't half bad. However,
It was actually a little longer than that. So I think through 2010.
2011. 2011.
Right.
Yeah, it was $730 an ounce to like 1,100. Wait a minute. I have the numbers right. There they are. 730 to 1825 by 2011.
That's a pretty good jump. Yeah, in a short period of time.
But get this. It went to 1838 over the next 10 years.
Yeah, you really got to time in, you got to time out, and that's really difficult for any security.
855-935-TALK is our number. We're talking about inflation, but we want to talk about those things that are really important to you. So give us a call, please.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Welcome back to the show. I'm Don. That's Tom. The number's 855-935-TALK, 855-935-8255. And I was stupid on Tuesday.
How's that?
What reason I think I got this bug, whatever this bug is, and I don't really know yet, is
You left your little room there?
I did. I left my bubble. My daughter and son-in-law and granddaughter came down from Pennsylvania to visit. And so they got together with all their friends and family at a microbrewery.
Mass spreader event?
And there were a lot of people there, and it timed out perfectly because it was on Tuesday, and I started feeling sick on Thursday night. So probably just going out in public, it was my own fault. Stupid.
So they taped you in, have they locked you into your little room there now?
Yeah, it is hermetically sealed now. Yeah.
From the outside? Okay.
It is. It's sealed.
Slide your meals under the door?
855-935-TALK. You need to call and ask questions of Tom. I don't know if you should ask them of me. I'll forget what the question was by the time I get to the answer. 855-935-TALK. As a matter of fact, let's see. What were we talking about? Oh, inflation.
Well, right.
Inflation. Like, we were talking about gold. And between 2008 and 2021, the price of gold went from $730 to $1,838. So it did go up over that time.
Yeah.
But
pretty good run.
The S&P 500 went from 1213 to 4173.
Quite a bit better. And of course, the S&P 500 has companies in it that are paying dividends, et cetera, in addition to all that. But the question is, if inflation is here, okay, so we're not gold bugs. And by the way, James McIntosh, not either. He doesn't think gold makes sense. Gold does have these little periods where it does great, and then the rest of the time it doesn't. Good point, Don. But he also takes a look at commodities. Now, some commodities have already had ridiculous run. I mean, look at the lumber in the last year. I'm glad the place is already built, because if not, I might want to go take down my own trees in the backyard, because lumber has gone up dramatically. Copper and oil up more than 30% this year. Lumber's almost doubled. And the stocks of global mining and major oil companies have strongly beaten the broader indexes. So that means, should you be buying commodities to protect yourself against inflation?
No.
That was a question.
Yeah, no. And the reason is, again, because commodities, gold is a commodity.
Yes, it is.
They're basically the same thing. A commodity is not designed to become more valuable of its own volition. It only becomes more valuable if its demand increases or its supply falls. Period. That's the only reason. And you'll find that with some commodities, for example, we saw this happen with oil. When oil prices got very high, that incentivized people to find new ways to get oil, and they increased the supply dramatically, and oil prices plunged. The same thing can happen with anything else. If copper prices go through the roof, that will incentivize people to reopen old, poor-producing mines that weren't cost effective in the past, but may be with higher prices. You don't get rich on commodities. They're a gamble. Or they're a hedge for farmers or producers.
Which does make sense to those people that are producing those goods. You should, have some sort of hedge. I also suggest, in a big picture sense, I like stocks because companies, when facing increased demand, increased wages, or the material they use the cost of that goes up. What do? Oh, that's right. They raise prices, right? They pass that along to us. So stocks have done pretty well most of the time in inflationary times. He mentions that he likes value stocks, right?
Value stocks have done, as a matter of fact, growth stocks have tended historically to do better in periods of low inflation. Value stocks have done better in periods of higher inflation, which is a great argument for overweighting to value anyway, because inflation at least has tended in the past to almost always exist. We have had short periods of little or none and very short periods of deflation.
That's a good way to put it. The thing is, just back to the stocks thing for a moment, we're going to suggest, and you've heard it from us before, that you own value and growth stocks. You own big firms and small firms. You own U.S. and international, this global diversification of all kinds of companies. Now, we do think you should tilt the portfolio a little more to small and to value, that's helped over the long haul.
And that, by the way, is for some very, very obvious reasons. The reason that small company stocks and value stocks have over decades-long periods of time tended to outperform growth and large company stocks is because, they're riskier.
Yeah, they're not as solid as those huge companies like
it's a risk.
Washington Mutual.
Everything is a risk-reward trade-off. And the minute you understand that, you are going to save yourself so much investing grief. If you can just get it through your head that more return can be had, but it requires more risk, and the risk is real. It is not, I don't mind risk if I don't actually experience anything bad. Risk is good as long as I don't lose money. I'm okay with it.
As it only goes up.
Yeah.
And you missed I was having a little fun there.
Oh, my brain
small
is
companies
dull.
are not as risky as large companies, like WorldCom, Enron, Washington Mutual. They're safer, right?
Yeah. Oh, yeah. General Motors. Yeah. Remember when it was doing?
Of course. Yeah. Eastern Airlines, and some of the great ones. So what about here's an idea that I do like. Now, you'd only want to do this in your retirement accounts, like an IRA, 401k,
explain why,
something
please,
like that.
Sir.
Well, the reason why, first of all, this is Treasury inflation protected securities. TIPS. The U.S. government issues them, and then they readjust them for unexpected inflation every 6 months. So the problem of owning them in a regular taxable account is you're going to pay taxes on that interest. I don't want you to do that. I'd rather have you own those in your retirement plan. The problem is they're not very many retirement plans.
Well,
you got to go out and buy them yourself.
They don't pay interest; they accrue interest. But
correct.
The interest,
and then
you don't actually
boom.
get interest, but you have to pay taxes on the interest that's imputed, and that's really the negative about these things. You don't want to pay taxes on interest you didn't get.
Yeah, and so they're not a very good solution, as I say, in post-tax accounts, and in very few that I see. Very few retirement plans.
But remember, they don't pay much. In fact,
no, they don't. But they're a protection there against unexpected inflation, and that's the reason you own them. Another one that he suggests that I do really like, and that is short duration assets. We believe in short and intermediate term fixed income bonds, right? Because the longer you get out, the more risk you face when interest rates do go up. If you own a 30-year bond and it's paying 1.5 and the government issues a new one at 1.8, guess what? The value of yours just went down.
And dramatically.
No reason to own it anymore. Yeah, I mean, people forget. But so in a general sense, bonds have nowhere near the volatility, but I would like to keep my assets duration short in times like this for sure. Definitely.
855-935-TALK is our phone number. Give us a call. We'll try to answer your questions about the better ways to invest, the best ways to manage your money, how to plan for future events. Give us a call.
Tom and Don are talking real money.
Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Hey, everybody. Welcome to the program. I'm Don McDonald, along with Mr. Thomas C. Cock over there at that studio place where he's at his house, and I'm at my house in my little studio
Maltby,
place.
Washington headquarters, right here.
Yeah.
Right down the road from very famous place like the Maltby Cafe. I can smell it.
Actually, I'm just down the road from a much more famous place than you're down the road from. Yeah, it's called Disney World.
What, a sinkhole?
Disney World.
Sinkhole or something.
In fact,
bad.
my daughter,
Rotting Everglades.
my daughter, son-in-law, and granddaughter are at Universal Studios today, Harry Pottering their brains out.
Now, I want to make sure I got this straight. In
What?
Florida, you can come from out of town and go to those places, but you can't do that in California yet, right?
I know, different world.
You can't go to
Well, come on,
Disneyland.
think about the political climate in the two states. Just
All right. So you're saying it's politics?
partially
All right, just checking.
politics. Sure,
Okay.
it is. Of
All right,
course
just
it
a
is.
question. Yeah.
855-935-TALK is our phone number, or you can send questions into us. You can type them, or you can actually speak them by going to talkingrealmoney.com, going to the contact form, and then doing what David did right here, just like this.
Hello, Tom and Don. How are you doing? I had
Good.
a question about your small cap allocation. I currently have the Vanguard VSMAX, and I know that you guys always talk about the Vanguard VSIAS, which is the small cap value. I currently have the small cap blend, which has 1,464 stocks. Your small cap value has 931 stocks in it. I wanted the blend because it has a combination of both of the things that I was looking for, value and growth. And I just wanted to know, should I split the baby and just put half of my allocation and just split it between both of those, or should I just stay in the Vanguard VSMAX like I already have? Thank you, and I appreciate your podcast. I listen to it all the time. Have a good day.
Thank you, David, for the question. We
that's
really
very kind.
appreciate
Yeah.
it, and it's a good question. Really
It
is
is a good question.
because the small cap blend does get you growth and value. What think you, Thomas?
Yeah, I you know what? I agree. I think it's kind of splitting the baby here. I just want to give the ticker. Is that okay? So people know.
He gave him.
I know you're going to hate me for it.
VSMAX.
V as in Victor.
Yeah.
V as in Victor. Yeah.
Oh, you're not doing it. You're going to do it with you.
S as in Sierra. M as in Mike.
You know, the show's
right?
only 2 hours long on the radio.
A as in Alpha, and X as in X-ray. Here's what I would do.
Yeah.
I'd split it between those two.
I just was going to agree. I agree wholeheartedly because we want you to.
Depends on the amount of money you have, but that's what I would.
But we want you to overemphasize value, only because it has historically slightly outperformed. So we want you to overemphasize it, but we don't think you should forget about the value growth stocks, and the blend gives you both. So add the small to the portfolio. I mean, the small value to the portfolio, and I think you will have solved the dilemma.
U.S. small value, by the way, up about 35% year to date. U.S. small growth up 10% less than that.
Yeah,
that doesn't mean it's going to happen all the time.
I mean, but if you look at the last 10 years, the growth fund did better than the value fund.
That's a good question. I'm going to take your word for that.
No, I'm pretty sure, but I'll look.
I'd take a look at that. So no, I mean, so I think the simple explanation is to put half in one, half in the other. The cost, man, I can't believe 5 basis points to own that fund. It's so doggone inexpensive. So you're really getting a great asset class. You mentioned it has about 1,000 securities in it, which is just terrific. You get the value exposure by owning the value fund and the more blend type. And this is a good point though, Don. You know, when we give people the simple 3-fund portfolios at TalkingRealMoney.com, you really don't end up with very much of the small. You end up with very little of the value. We're trying to give you a simple portfolio, but if you can do this, where you have more of the small and certainly small value over time, we would expect it would make you more money. So these are small things, but again, some of it depends on the size of the portfolio, I guess, too. If you had sizable assets, you definitely want to own both of those funds. You want to have a value commitment. If you don't, then you're probably okay not.
Yeah, I don't have a 10-year track record on the value index. I'll have to look. I saw it somewhere else, but let me see what I can find. 855-935-TALK is our phone number, 855-935-8255. Call. Let's talk about your life, your money. Make it better for you.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
Reality radio for a really great future. We're talking real money.
Talking Real Money continues. I am Don McDonald, trying to be in good voice. That is Tom Cock over there, doing his best to just stand upright. No, I'm kidding.
He's most days, that's a challenge, as you know. So
he's in much better shape than I am today. I'm sorry. I hope it didn't. I hope I'm not driving you all away. Give us a call at 855-93. They're kidding. 855-935-TALK. 855-935-8255. My voice is usually pretty good. This is rare. I don't get a bad voice very often.
No, usually in good timber.
So I'm not doing any
today.
short stories today. In fact,
no, I think you should
when I'm done
right
with you,
after
I'm going
this
to go nap.
Find the bourbon you previously mentioned, and
It's
have
gone.
an appointment.
I'm out.
You get somebody bring that over in about 15 minutes.
Debbie, go get me some bourbon, please.
Real stuff.
All right, we'll see. It won't happen. 855-935-TALK is our phone number, 855-935-8255. Before the break, Tom challenged me on the Vanguard Small Cap Blend Fund versus the Vanguard Small Cap Value Fund over 10 and 15 years. Which one performed better over 10 and 15 years?
Now, let's just differentiate those, first of all, just so everybody's clear. The blend has mostly growth, but a little bit of value.
It's a split. It's pretty close.
Is it close to 50-50? I thought it was far more, but I was looking at the style box.
Yeah, let me go back to the style box again because I'm on a different version of it.
And by the way, you can do this with any mutual fund you own. You can go to Morningstar.com and it's free. Dead center. Okay.
Dead center.
So it's a split between growth of the more successful
earnings
stocks,
growth,
right?
yeah. Growing companies.
Versus value of the prices of securities that people think should be greater due to their value when you look at all the stuff they own, et cetera.
Correct.
So the growth there is the previously mentioned fund, and he was asking about throwing in a little bit of value and what's been the difference. So you looked at 10 and 15 years.
And the blend fund outperformed over 10 and 15 years. It did about a percentage point better for both periods.
A year.
Yeah, per year.
Wow.
That's pretty substantial.
Significant.
But again, here's the thing. Up until over that 15-year period, we have gradually been hearing more and more investment professionals tell us that value stocks have seen the end of their run and that it made no more sense to be in value. And about the time
famous manager quit last summer. Over. I'm out.
Right about the time they said that, value blows growth out of the water.
Which it has over the last year, basically, right? Small value's really been a cranker. Hey, you got to own those all the time. So back to the question at hand. Because somebody texted me and said, how big does my portfolio need to be to split it rather than just owning one fund, essentially? fewer funds, how much money do I need to have before I really get sophisticated about all this?
If I have a few $1,000s, if I'm like at $10,000, I'm looking at 2, maybe 3 funds max. That's where our 2 or 3 fund ideas come into play.
If you really want to get tricky with it, then if you wanted to go there, I would own with $10,000. I would own the global, the VT, and then I might throw in like a third of it into the U.S. small value.
Oh,
or even just the U.S. small. Yeah, because remember, you got basically no exposure in the VT. It's just so infantile. You get like 1.5%, a tiny number.
So,
okay,
but
maybe
you're talking for 100% stock investor.
100%. Yeah, I'm not talking no bonds.
No
bonds. Yeah.
Who's willing to take a 50%? 50 or more percent drop in a single year.
If you're 30, that should be happy days for you. You should be buying more shares anyway. But that's a whole other.
Wouldn't it be great if everybody could get that mindset where when the market has just fallen, you should be buying more, not getting scared.
Don't you do that with other things in your life when things go on sale? Don't you tend to buy more of them? Generally, I mean, like Nordstrom has a sale. I think they sell more stuff at that time of year.
But people have a hard time with investing because it's fear that drives prices down, and that fear overwhelms common sense and logic. The logic telling you that is the entire economy going to collapse? Come on.
So we'll come back and we'll give you the actual answer to this, because how much money do you need before you really start you use Paul Merriman's, for example, 10 Vanguard fund portfolio.
And it's not just money either. We'll discuss it. 855-935-TALK is our number. 855-935-8255. You should call now. It's good.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Let me go ahead and give you that phone number again, shall I? 855-935-TALK, 855-935-8255.
Well, our lines are open, so please give us a call. I'm just sitting here waiting. Hey, Seattle, come on, I know you're out there. Hey, look, I realize it's a sunny day, but on all those rainy days, I was there for you.
That was from Frasier. Classic. One of the classic talk shows of all time that didn't exist.
Indeed.
On KACL in Seattle. Was it 780?
Call letters that don't exist and frequency that also does not exist. There's no 780. But
there is a 780. It's just there's nobody on it.
Not in use by the Federal Communications Commission.
Well, not in Seattle, but somewhere else in the world.
Period.
Oh, come on.
Not in the great.
But they use 780 AM. Oh, you know, you shouldn't.
Now you're going to make me look this up. All right, can we go to the phones while you do that? But actually, you need to finish the Vanguard question first. Then we can go to the phones.
Yeah, WBBM News Radio in Chicago is 780 AM, sir.
I thought that was a frequency that was never used. Interesting. There it is. I stand corrected.
About time he admitted he was
Looks like the only one.
No, WAVA 780 AM in Washington, D.C.
And I don't get to Washington enough, I guess, or Chicago, apparently. So, all right, I stand corrected. But what do you say? Finish the Vanguard answer, then we'll go to John.
I have a cold. I can't remember what we were talking about.
Well, the question is, how big does your portfolio need to be before you can start getting into a 10 fund, for example, portfolio?
You go ahead and tell us all.
Well, here's my take. It depends on how hard you want to work.
That is actually a good answer.
And it depends if your money is in a qualified or non-qualified account. Because if it's in a post-tax type account, the rebalancing becomes trickier. There's that. Number 3, I believe Vanguard has a $3,000 minimum on the funds. So you have to have a certain amount
on their funds.
So that would mean you'd have to have $30,000 to do that. So there's some restrictions there. And we could talk more about Vanguard's issues too.
Really, if you're gonna do the work, then it may make sense to at about $50,000 to $100,000 to start building a more diversified portfolio. KOH in Reno, WCKB in South Dunn, North Carolina.
WCKB. Yeah, right.
So,
I get there.
There you go. 780 used all over the place.
Stand corrected.
Okay.
Those are all, by the way, I noticed those are all east of the Mississippi.
No, KKOH in Reno.
Oh, pardon me, Reno. Yeah, okay. But otherwise, all right. I'm not winning this argument. I'm out, man.
John, thanks for bailing us out. Welcome to Talking Real Money.
Hey, thanks, you guys. I've been listening to your show for years. This is the first time I've ever called in to talk radio.
We are honored.
Yeah. So the 30-second background, I just turned 63. I've been invested in index funds through various entities, mainly Schwab and Vanguard, for years. I'm hoping to at least semi-retire when I turn 65, so less than 2 years. Hooray!
Yeah.
But all my index funds have been growth funds. I think it's a pretty standard mix for a lot of people. Most of it's in the Schwab S&P 500 index, and then the rest, kind of evenly distributed as small cap, mid cap, small cap foreign, large cap foreign, and I really want to look for more dividend income, and I've been looking at REITs for like a year, and I look at the index fund REITs, and the dividends are okay. I'm looking for at least 4%, but the fees they're a little high for me. They're like 0.5, 0.6%, sometimes more. So what I've started to do, and I want you guys to tell me if I'm crazy or partially sane, I've been looking at individual stock REITs, and I've hardly ever bought individual stocks. But I've identified a few, and I think there's quite a few more that are paying.
All right, let me stop you right there, if you wouldn't mind. I think you're approaching this wrong. And you're falling into a trap a lot of people fall into. They want their portfolio to actually generate the income without touching the principal, and that is very close to cutting off your nose to spite your face. Because when you're getting into 6% REITs, you're getting into REITs that have risk.
You mentioned, I think, 4%, before 6 or whatever the number. REITs should be part of, I think, everybody's pre-tax portfolio. No. REIT funds, pardon me. And I'd have to go look and see what Vanguard's REIT fund, what the cost is. REIT is a real estate investment trust. REITs own shopping malls. Remember when we used to go there? They own apartment buildings, etc. So they are. Actually, I went to one in Phoenix not that long ago, so I shouldn't say that. But REITs are an important part of an overall portfolio. Here's the reason I would own them. Is because they don't go up and down the same as
here's what he's
stocks
saying,
all
here's
the
what
time.
he was saying. Buying individual stock REITs.
That's way too. That's like buying individual stocks of any type, any stripe. That's just too risky, especially if you're getting ready to retire. We don't like individual equities because they have that thing called default risk, and the return should be similar to what other stocks it's like, right? Large REIT, etc.
And here's the thing: you can create a 4% dividend yourself if you have a well-balanced portfolio that is properly diversified for your risk tolerance, that's somewhere between 30% in stocks and 80% in stocks. You should be able to very easily pull out 4% plus inflation every year, dump it in your bank account, and live off that for the rest of the year, creating your own dividend. And by the way, the Vanguard Real Estate ETF, which is almost all the REITs in the country, has an expense ratio of 0.12, not U.S.
Just U.S.
U.S. But 0.12,
so I would own that.
cheap.
Mm-hmm. That should be in your portfolio. Don's exactly right. You can create your own pension simply by, at the end of every year or whatever date, rebalancing the portfolio, taking money from the things that did great, putting the cash in your pocket, and rebalancing the portfolio to the things that didn't do as well.
And Dan, you're up next. Welcome to Talking Real Money. Hi, Dan.
Good afternoon.
I have Brenda.
Gentlemen.
Oh, hi, Dan. Sorry. Go ahead, Dan.
Looks like I'm on now.
You're on. Yep.
Yep. Thank you for all you guys do. I spent 30 years as a gambler and spent 2 years trying to find someone who could speak good financial sense, explain things in a very logical and clear way, remove the obfuscation. That word's for you, Don.
We're anti-obfuscation, yes.
Yes, and trying to help me become truly an investor. And you guys have done that, and I'm most appreciative.
Our pleasure.
There was a
Thank
quote
you,
at the end of Jason Zweig's article last week that really struck me. It comes from a Hungarian stockbroker. It says, I can't tell you how to get rich quickly. I can only tell you how to get poor quickly. That's by trying to get rich quickly.
Good point. And Dan, we're going to run out of time. Did you have a question, or you just wanted to share that?
No, the question was I wanted your views on the Wall Street Journal article on Wednesday on 5 tactics to investing amid rising prices.
Okay, well, we kind of talked about that a little bit, but we will address that a little bit more in the next hour because we're coming up on the end of this one. Thanks so much for the call, Dan. We really appreciate it, and the nice comments. 855-935-TALK is our number. You can call that 24 hours a day, 7 days a week.
Tom and Don are talking real money.
Want a free copy of my book, Financial Physics? Well, go download it right now at vestory.com, vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Matter of fact, Dan, I want to answer your question really quickly. One, you've got to actually know that prices are going up and will continue to go up. You can't know that based on what has happened. Remember, you can't predict the future. But we believe you should always have stocks and tips in your portfolio to protect against rising prices, inflation.
And most of the time we look at your portfolio, you got a lot of stuff, but it's really not generally diversified. You're generally paying others too much, and you oftentimes are taking too much risk or not enough risk. So we invite you to come by and get a free look from an advisor. There's no cost, there's no obligation, no sales pitch. We do this for people because we want you to get it right when it comes to your money. How do they do that, Don? Tell them how to sign up.
So easy. You just go to our website, vestory.com, vestory.com, and go down to the bottom of the page and set up an appointment, vestory.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information.